get into the fundamentals here. This is really why we why we do this game. As a former subscriber myself, this is kind of one of the key reasons I loved Hedgeye was the concept of preserve, protect, and compound those hard-earned assets for a whippersnapper like me, a 38-year-old young man with a family and soon-to-be 6-year-old and 4-year-old kids. That wealth I'm building is really important, and I'm trying to preserve and protect that and compound it for my retirement so that we can have a prosperous and happy life together. And for many that are older, right? We're closing in on retirement age. I speak to many within Hedgeye Nation. This is exactly right. This is where weathering these quad fours and preserving, protecting your capital so that you can come out on the other end and do your best to compound, right? Using that fixed income exposures or just being more more conservative with the overall allocations. Keith, as of right now, is just a little north of 70%. I think 2 days ago was about 76% cash is what I wrote down, if memory serves. Yeah, 76% cash in his portfolio, right? So that kind of should be a telltale sign in terms of how he's thinking about his portfolio and his hard-earned assets. He's about 10 years older than me, so he's he's pushing 50, and I'm pushing 40. So here we go. Just a couple of young guys, young Irish Canadians, now Americans, here at Hedgeye. But really, the point of this slide is to bang home position sizing. This is a really critical way and a crucial way of trying to risk manage the portfolio, right? So if you don't get over your skis and too big in a position, it really, at the end of the day, shouldn't impact or hurt the portfolio that much, right? If you got a 200 basis point position in a single stock, then that overall drawdown, if it's say 50%, it's a very it should be a kind of a relatively nominal number in the overall book of business or book that you're managing, whether it's for clients or your own self, right? So the key thing here, again, if we go down to max sizing from largest to smallest, we start with FX, so foreign currencies, things like the dollar, the pound, the euro, et cetera, right? Those max out at 12%. We also do include gold in there, so the GLD would be that ETF, or gold futures is another way to play that. But basically, so foreign currencies, FX, lower volatility assets or pieces of inventory. Next up would be fixed income, a 10% max position. Equities, so that's going to be ETFs, right? ETFs, not individual securities. Not individual securities, as the ETFs, is 6% max equity position, commodities of 4%, and then lastly individual stocks and options at 1% to 2%. Again, depending on your book, right? Depending on your risk parameters, your tolerance, your goals. I had a phenomenal conversation with Dr. Andrew Menaker last night on Twitter Spaces. It'll be up on the podcast channels and Hedgeye YouTube here later today or tomorrow morning. You can also watch, listen to that replay on Spaces. But a big thing that he finished the call with, or our conversation with, was getting not only the outcome goals and setting those, so getting those right, but also getting the identity goals, right? So like, where do you want to be in who do you want to be in 3 to 5 years? Where do you want to be in 3 to 5 years? What's the outcome with the portfolio? But then what is the outcome personally as well? And getting those two things to sync and being conscientious as to what that means, right? Like, do you have an identity of buying a second home as a retired individual, as a soon-to-be retired individual, and trying to get that retirement home down in Boca or wherever, and that's your goal, right? So if that's your goal as a late 50 or early 60-year-old, then really your core focus should be on preserving and protecting the existing capital that you have. Trying to short and execute on the short side in terms of this market might not be a top priority for you, but taking advantage of some some of the short-term treasuries that are out there that are paying 4%, that, or money market funds at 4.5%, like Keith has mentioned on it's FDRXX is in his number one asset allocation inside of the re-ranked product for Macro Pro. Those can be really key focuses for you, right? So we try to give a big broad picture as to how to build your portfolio and things that are important, and how to set up and take advantage of the current market. But you also have to take a step back and assess what is important to me, right? Like how do I take this information and then truly kind of build a portfolio that mirrors and will execute not only the outcome goal but also the identity goal. I really love that terminology from Andrew Menaker. It was a really great combo. So anyway, back to this slide and this point. We also, from a position sizing standpoint, will have our min, our mid, and maxes. If you're starting a new position, always take it to the mins. Now, it doesn't necessarily mean that you just hit the button and say, I'm buying 200 basis points right here, right now. But you can incrementally add up to that over the course of the day, or, and so, doing so in 25, 50 basis increments, maybe going up to 100 basis points if you need to, in terms of something with a lower volatility that's at the low end of the risk range, like a UUP or a GLD. But the point is that we've got our min, our mid, and max sizing. We do incrementally shift those up and down, or I guess I should say up and down, in terms of sizing. So again, the example there is for ETF equities, right? So or general ETFs, whether it's US, international, emerging markets, they all kind of function the same, but it would be a minimum sizing of 2%, going up to 4 as your mid, and 6 on the long side. On the short side, it's always going to be 50%. This is kind of the parameters that we have in place. So it's 50% of your max longs or of your min, mid, and max position sizing. So in this example, and for Keith, and this is what I've adopted myself, it's 1 min, 2 mid, 3 max in terms of the short side on terms of total positions. So again, the whole goal here is preserve, protect, and compound, right? So just reflect on what are the outcome goals and identity goals. I'm going to kind of say that again because I liked it so much from last night. But yeah, so the core concept of the show. So again, this is a beginner's guide. Some like David Salem likes to call it kind of continuing education. You can call it whatever you wish, but at the end of the day, we're here to try to improve and get better, right? Like review the tapes, take some of the questions from the macro show, or generally that I've seen kind of in the arena or on Twitter, and really try to dive a little bit deeper into them and kind of expand on some of these questions that Hedgeye Nation has.